Hello, everyone. Welcome, and thank you for joining us for today's event, Saving for Now, Later, and a Lifetime, a summit on the foundational role of liquid savings. My name is Saurabh Kohli. I'm a senior manager at Aspen Institute's Financial Security Program. One of the areas I focus on is our work on the topic of inclusive savings, which gives me the privilege of working closely with committed leaders on the design of automatic emergency savings solutions. Some of those leaders will be participating in today's discussions. As many of you know, the Financial Security Program's mission is to illuminate and solve the most critical financial challenges facing American households and to make financial security for all a top national priority. At the core, there are three essential building blocks of financial security. First, routinely positive cash flow to cover expenses and allow for savings. Second, personal financial resources, which are the savings and financial cushions that support household resilience, wealth building, and well-being. And third, public and private benefits that can provide a functioning safety net to fill in gaps in the current economic system and protect individuals against financial catastrophes. The focus of this summit is on liquid savings, which are perhaps the most prominent example of personal financial resources. And according to the Consumer Financial Protection Bureau, liquid savings are the single variable most highly correlated with financial well-being. On behalf of my team and our partners, I would like to thank the BlackRock Charitable Fund for supporting today's important discussions on the essential role of liquid savings in financial security outcomes for households. To help set some context, I want to talk about the cycle of savings. Rather than thinking of household savings solely as something that just grows and grows and grows, we instead refer to the pattern of household savings as a cycle. The cycle is an ongoing act of building savings, using and spending savings, and then replenishing savings, and so on. We know savings should be used when needs arise and to meet personal goals. Through a cycle of savings, individuals and families can strengthen resilience against financial shocks and invest in their well-being and economic mobility. The cycle of savings concept reinforces that saving is a habit, not simply an amount. And the cycle of building, using, and replenishing savings illuminates how account balances alone are just point-in-time measures and not complete indicators of measuring savings success. Recent research shows that families with liquid savings prior to the COVID-19 pandemic, regardless of income, were in a better position to withstand the economic impacts of the crisis. Additionally, research has shown that liquid savings are critical to building and maintaining retirement savings. Households with liquid savings were less likely to borrow or withdraw from retirement plans, which shows that liquid savings are complementary to long-term savings, not in conflict. However, the pandemic also further revealed longstanding disparities in savings access and outcomes. Less than half of Black and Latino households were able to save prior to the pandemic. The same was true for low-income and renter households. These households were also most likely to lose income in 2020 and therefore most in need of a liquid savings buffer. We know that people cannot build and replenish liquid savings without both reliably positive cash flow and simple and affordable products and platforms that make it easy to set money aside. We have seen historic economic stimulus at the household level and a push for federal anti-poverty measures. These measures can provide much needed cash flow and put savings within reach for many households. Yet we know that many households still need longer term solutions and easy access to high quality, affordable savings tools. Today, we'll dive more deeply into the latest research about how savings function, why so many US families have been unable to build them, and what leaders, including policymakers, employers, and financial services providers can do to accelerate the development of a truly inclusive savings system. We have organized 3 panels today with expert speakers who are dedicated to the same vision. Our first panel will explore the protective role of liquid savings, why they matter, and what it takes to build them. Then we will have a discussion that applies the evidence and research to product and policy solutions. And then we will wrap up with a conversation on how we can make emergency savings more automatic like retirement savings are for some. We'll have some short breaks built into our programming today in between panels, hopefully giving you enough time to refill your drinks, grab a snack, send an email, or whatever you need to do. Please tweet with us. You can tag us with the handle @AspenFSP, and you can use the hashtag Aspen FSP Live. Please also consider using the chat function in Zoom to chat with all the attendees, or you can send your messages directly to the panelists. We encourage you to share any thoughts, reflections, or even links to relevant research or initiatives. And to ground today's discussion in the context of real financial lives, we'll be showing 3 short videos of SaverLife members talking personally about the importance of savings. SaverLife is a national nonprofit fintech company that helps working families achieve prosperity through savings. SaverLife is a partner across much of Aspen FSP's work and a member of Aspen FSP's Consumer Insights Collaborative, which is a joint effort with 9 leading nonprofits to collectively understand and amplify data for the public good, specifically about financial lives and the needs of low and moderate income households. And we will begin by hearing from SaverLife member Sierra. So let's see if we can cue that up.
Hi, my name is Sierra Dobbins, and through SaverLife, I have learned so much. I mean, I'm 27, 2 kids, raising them alone. I've got an unsecured credit card. I was able to boost my credit. We are now getting a house. I'm working on getting a better car. You go on there and you do your little readings and your quizzes. I've also learned so many things that I could share with my children. You know, my 9-year-old, she knows how to save now. Also, I earned $10 doing the scratch offs, so it's fun. You know, it's fun, and I'm a young mom. Get into it. You know, definitely make your SaverLife account. It's gonna help you. You know, I was born in a not so good neighborhood. I'm trying to get my kids to the best neighborhood. And with SaverLife, there are step-by-step instructions to teach you how to multiply and save your income and also use it in a wise way. I just want to say thank you, SaverLife, for helping people like me, mothers like me, single fathers. Thank you so much.
And I'd like to thank Sierra for sharing a bit of her personal story, her motivations for saving, and for explaining what she has found supportive with a solution like SaverLife. With Sierra's powerful statements and a framing in mind, I would like to introduce my colleague Sheida Elmi to lead our first discussion.
Maybe some Zoom technical difficulties. The video says I cannot share it because the host has stopped. So I will just chat while we get that sorted. And meanwhile, I will just build off of what Saurabh just said and say thank you to SaverLife and to Sierra for sharing this. Really appreciate being able to load up, highlight the actual personal reasons that people are sharing. Oh. There we go. Okay, sorry about that. Sierra's video really highlights all the personal reasons that she is saving. So much is driven by wanting to find ways to build a better life for her kids. She's in the midst of purchasing a house, saving up for a better car, hopeful to move to the best neighborhood for her children, and already teaching her child to save. This video lines up well with the discussion we hope to have in this panel, which is really to demonstrate the role of short-term savings in people's lives, how individuals and families actually build and use those savings, and to address that there are barriers that need to be navigated around and designed for if we are interested in making that easier for people to accumulate savings. So with that, thank you. Great. Let's have all of our first set of speakers. Please turn on your cameras, join me on screen. And I think as they are appearing for me, Caroline Ratcliffe, Senior Economist at the Consumer Financial Protection Bureau, Steve Wendell, the Head of Behavioral Science at Morningstar, and Bradley Hardy, an Associate Professor at American University. As Saurabh said, my name is Sheida Elmi. I'm the Research Program Manager at the Aspen Institute Financial Security Program. Thank you all for joining us. And to all of you who have tuned in. I want to start by zooming out momentarily because Caroline, you have been deeply engaged with savings research, and I don't want to miss the opportunity to have you highlight at a high level some of the learnings, the realities about liquid savings that researchers in the field have known for years. What should individuals tuning in today know about those findings? and why short-term savings are so important.
Great, thank you. Before I start, I just want to say the views that I express are my own and do not necessarily reflect those of the CFPB or anyone else. So I think I'll answer your question, just make 3 broad points at a high level about the benefits of savings, which we heard some in the intro, amount of savings that help people weather shocks, and then strategies to help consumers build savings. So just in terms of the benefits, that having liquid savings matters for financial security, that the data show that people with liquid assets have lower levels of material hardship. They're more likely to be able to pay rent and mortgage and other bills on time. They're less likely to be food insecure, also have higher levels of financial well-being and lower levels of financial stress. It can be hard to disentangle some of these levels of savings from other aspects of consumers' lives, but these studies have followed people over time. Also, I think there's a randomized evaluation that contributes importantly to that literature. And then the second point is around the amount of savings that help people weather shocks. That even small amount of liquid savings matter. There's an Urban Institute study that shows that having as little as $250 to $750 in savings is associated with lower levels of material hardship when unexpected shocks hit. Not surprisingly, as the amount of savings rise, the level of hardship falls further. There's a couple other recent papers that I'll summarize as saying that about 1 to 1.5 months of income saved is sort of helps consumers with these shocks. So there's one paper that's trying to get at this rule of thumb, and then an approximate savings rule is for average low-income household to have about 1 month of income or about $2,500. And then there's a JP Morgan Chase Institute study that's at the median. The savings buffer needed to deal with expenses and income shocks is like I would say expense and or income shocks is about 3 to 6 weeks of income. So kind of pulling these together to say even small to modest levels of savings can help people weather these shocks. And again, as we heard, kind of this cycle, building it up, spending it down, and then building it up again. I'd say we know some about strategies to increase savings. And, a lot of these are sort of, some of them are like looking at the margin. So first, like financial incentives to save, that these small interest rates, the bank has 5% interest rate, that's not found to increase savings, but some of these other larger financial incentives, like these financial matches, like $1 match for $1 saved, we know increases savings. And from these evaluations, we also know that low-income people can save, especially with these financial incentives. And then default and design of these programs and products matter. So like default into savings programs has been found to increase savings. So we're really thinking about at the point of entry with the employer when people get paid. But a lot of the learnings here come from retirement savings literature, not the emergency savings literature. There's reasons for that, which we can talk about. And then framing and design of products and programs, as I was saying. So like prompts to save, think about tax time, motivation. There's research that suggests that the way we frame the savings amount matters. So suggesting that people save an amount per day was found to be more effective than framing an amount per week or month, so that the $5 a day gets more people to save and save regularly than $35 a week or $150 a month, even though they're the same. So I'll leave it there. We do have at the CFPB, we put out an evidence-based strategies to build emergency savings report that's available to folks.
Fantastic. If you want to drop that into the chat, I'm sure some folks would be really interested in hearing about that. So thank you, Caroline. I appreciate you managing to sum all of that up, bringing everyone listening today up to speed on some of those critical reasons why short-term savings are so important in people's lives. And even that these really, smaller amounts are really important. And so that we can keep that in mind as we think about what are the barriers, what are the ways that we can move people towards that as we move on in the conversation today. Steve, I'd like to bring you in here to build off of what Caroline was just sharing. You recently published survey findings about financial resiliency of households in the US during the COVID-19 pandemic. Can you talk about those survey findings and in particular to the protective role that liquid savings and their connection to well-being and longer-term asset accumulation are?
Absolutely, happy to. I think the short version is, listen to what Caroline just said. We find in our survey the dynamics of that playing out during the COVID pandemic. I want to give you a little bit of background. So we ran a survey, 2,000 people, nationally representative probabilistic sample, in partnership, very thankfully so, with the Aspen Institute, NORC at the University of Chicago, and DCA, Defined Contribution Association. The survey was somewhat unusual in that we were able to get the same people before and during the pandemic and get very detailed information about their finances and particularly during the pandemic, how they were responding. And that first wave was in 2019, same people, same 2,000 households in December of 2020. And what we find in short is that, well, liquid and long-term savings are both connected and complementary. We see this in two ways in particular. The first one is very much echoing what Caroline has just said. We see, for example, among looking at, say, people with a 401k, we find that liquid savings increases the likelihood of paying one's bills on time, being able to manage one's debt. Very similar to the CFPB's great research in this field. And so that's one area. The second, which is a bit more unusual, is we found there is a direct protective effect of liquid savings for retirement savings. Now, I work particularly in the retirement savings and investing arena, and this is extraordinarily important for us in the field to see that, for example, if they doubled their liquid savings, so if someone otherwise equivalent household had twice as much liquid savings, that decreased the likelihood of drawing on their 401k or other retirement savings by 12%. Now, that is a big effect for us. Retirement plan leakage is a big issue. And so this is important. Second, we look at, for example, how different types of debt, if they're looking at different types of debt, are related to each other. We see, for example, medical debt. If someone has any medical debt, that is associated with a nearly 70% lower emergency savings. We also see that, well, again, building on what Caroline said, the presence of liquid savings, the presence of emergency savings is not equally distributed across the population. And in, sadly, some very common ways. We see that LMI households, twice as likely to have medical debt, which I said is so important in this space. We see LMI households in our study had 6 cents on the dollar in liquid savings for non-LMI households. That's about $100 liquid savings versus $2,800. And then what's particularly promising, and I think what we were really excited about with this, is that we see that that status quo, which is quite concerning, and we have a long documented history of it, it's not fixed. We saw that there was an impressive decrease in the unbanked population. That means people going from not having a checking or savings account as we implemented here to having one. And we saw, for example, that Black households, self-identified African-American households, self-identified Hispanic-American households were twice as likely to start off with to report that they didn't have checking or savings accounts after you control for income, age, etc. But that gap shrank considerably. Went from about 18% of African-American households to 12% who are unbanked in 2020. And what that tells us is there's not a disinclination to save. There's not a desire to say, hey, savings just isn't important among LMI households. But given certain contexts, the stimulus check, the increase in employment benefits, these things are movable. We can change this as a society, and that was a very positive result from, sadly, a long history of disparity in liquid savings.
Thanks, Steve. running through all of those findings and for also highlighting the ways that this data was unique. I was obviously aware because of the work that we did with you all for this, but really appreciate you walking everyone through that and for speaking to the ways that liquid savings are inherently tied to these longer term outcomes and highlighting some of the places that we really do need to be thinking about, like medical debt as a big barrier. So I think we will be coming back to that shortly, but something that you were saying also relates a lot to a concept that we talk about a lot at Aspen FSP. So Rob mentioned this, but we've done a lot of research around this concept of short-term and liquid savings and the ways that many people are engaging with them at this kind of higher frequency basis, meaning it's not just money that is set aside and forgotten about and just grows and grows, but rather funds that are set aside, drawn down for goals or needs that come up, and then built back up again. And what our work really highlighted there is not only how critical, complementary these kind of higher frequency cycle of savings, shorter term savings are to these longer term outcomes, but also highlights two major strands of barriers. Not having routinely positive cash flow, typically, people's income not being higher than expenses, which makes it hard to engage with setting money aside. And for many low and moderate income households, there's also a range of product and platform access issues and features that don't necessarily match up well in the lives of these individuals. So Bradley, I know that your work has highlighted some of these connections between the reliability and the stability of cash flow and wealth. So I'm curious whether this concept of routinely positive cash flow resonates with you and your work. And also, I know that you've been looking at some recent survey findings as well to see how people are coping with the pandemic. So I would like to invite you to share some of those findings.
Yeah, and I think that a lot of the work that I've been co-authoring kind of helps to set context along the lines that we have been thus far. And I think there's some interesting points, and kind of in no particular order, I'd say that when we think about savings, I think depending on who you're speaking with, they have in mind broader, large scale, even wealth inequality reduction. Right. And then on the other hand, you can think about savings in the context of more emergency savings and, allowing families to be able to buffer certain events. I think both are important. They're clearly going to, recommend different solutions. And I thought that, Sierra's commentary at the outset really did tease an important point, which is that some of these instruments might represent wins insofar as they keep families out of very costly debt scenarios, right? Holding high interest rate credit cards and loans that are incredibly unaffordable, but that in fact, in some instances, probably represent the best among a set of bad alternatives when households face quite a bit of expense volatility. So, I think that there's different ways that we could count these instruments as wins. But in terms of the broader context, absolutely. My own work and that of others in this field have documented that, low-income households in this country really do face, in some respects, the worst possible portfolio, as their resources are not just low, but highly unstable. And so this is the case for Black and Hispanic households where the adults have fewer formal credentials, less educated households, lower income households. And so we see this socioeconomic gradient where they have fewer resources. Those resources are more unstable. It's easy to see where this causes all sorts of interesting issues related to planning and anticipating. But at the same time, these households face important expense volatility. So you can think, for example, of a classic case of an unanticipated transportation expense, a car repair. And at times, the private sector can really be informative as to where there's a problem and a potential solution. At this point, an individual who goes into an auto repair shop and say has a $500 expense, maybe $6,000 to $1,000. Many folks on this panel and webinar, we might be griping about it and complaining about it, but we'd handle that. We put it on a credit card, pay it off quickly, pay it out in cash. Well, the bottom line is that the private sector has actually come up with instruments that are charging extraordinarily high APRs, basically for high-risk borrowers who don't have even $300 to $500 on hand to handle these expenses. And clearly there's a market for this. There are folks who are taking up just sort of these onerous APRs to handle what are not sort of qualitatively large expenses, but they're large for folks with limited resources. So, I think that clearly the savings and emergency savings represent an opportunity. Just one snapshot, in co-authored work with Jonathan Morduck, Sandy Darity, and Derek Hamilton, we find, for example, that among Black households with income of $40,000 or less, roughly 30% maybe had $5,000 in savings, and then well under 30% among them could effectively cope with the $400 expense. Now, the Federal Reserve data set, some folks like to gripe about how that question was asked, but it lines up nicely with this notion that no, when we triangulate around this, households really do struggle, very much related to this sort of limited savings. And I guess I would just close out by saying that there are questions then about how households are coping. So one of the reasons why you'd want to promote emergency savings instruments are that many households, depending on the data set, will turn to some alternative instruments that could span selling their blood plasma, overdrafting checking accounts, resorting to taking out payday loans. And so, sometimes it's how they're coping that we worry about that could have, longer term ramifications. So I know there's more to talk about. I'll stop there.
No, that's fantastic. I think that sets us up very well for some of the conversation that we're hoping to have here about, the ways that people are coping, the ways that people are addressing these needs in the pandemic does demonstrate a lot of where we can be thinking about systemic solutions, and we will definitely be talking about in the next panel. So one thing I would love to do is, prior research has really made it clear that liquid savings are critical to this wealth building piece. You've all just highlighted the sometimes dire or really big impacts of not having these types of savings handy. So let's turn to these barriers. We know from everything that you all have said and from our own experience, people want to save and they're trying to do so. So what are the things that make it difficult for people to save? What is getting in their way?
Sure, I can speak quickly to that. I think of the barriers of saving as financial and psychological. And often in these discussions, we look at one of those and not the other. So I'm going to try and briefly look at both. The financial is well known, right? That people's expenses, the fixed expenses, just getting by, well, there isn't much room left for savings. And we see, for example, we have a study coming out in a few weeks that looks at savings rates across a representative sample of Americans for the last 30 years. And we find that the single strongest predictor of how much people can save is their income, right? LMI households of the last 30 years at median have saved nothing to 1% of income. And this is on the wealth building side as we look long term. There may be some very healthy cycle of savings and short-term savings going on in there. We see that aligns with our history of discrimination and disparity. So, for example, well, African American households and Hispanic American households are disproportionately concentrated among low-income jobs, low-income households. And so we see among African American households, again, 0 to 2% across the last 30 years. And that's a significant problem as a society, right? And we have to address that income issue in order to address that financial burden that stops people from saving. At the same time, I think it's important to always remember that there are psychological obstacles too. That, look, the folks on the call, yeah, we can handle a medical expense, we can handle a car expense. But in the end, for most of us, our expenses rise to meet our income just as much, right? At just about any income level, people spend the money they have. And that's not necessarily a bad thing. As I'm a behavioral scientist, and we think about this as present bias. We are naturally focused on the present rather than the future. It is not a pleasant thing to forego current consumption for the future. And these behavioral obstacles are absolutely universal. Low income, high income, everybody has these behavioral obstacles. The problem is that as a society, our tools to help people with behavioral obstacles are particularly concentrated for the middle class and upper class. For example, the automation that you spoke to, Caroline spoke to earlier, that is primarily through our workplace savings plans, which are for people who are in a long-term job where they get eligibility to workplace savings, and then they can be defaulted in. And that's just not as common for lower income families. And so while our biases are universal, our current solutions aren't.
So maybe that's great. And maybe I'll just add to the conversation, the products that are accessible and affordable to folks that work, particularly low income folks that work. So that work for them. So if you think about, Steve mentioned sort of this defaulting into retirement savings, but if we want to think about defaulting people into automatic savings, or an employer wants to offer sort of a split paycheck option, that the worker needs a product to put those dollars into. So this can be a barrier for workers to save, to keep those funds separate. And so it's a barrier if the employer offers it, it's a barrier to the worker. The employer might not want to offer it or publicize it if their workers might not have a savings account or a large share. And we know that while the number of unbanked people has been falling, still about 25% of folks don't have a savings account. And while maybe I'll just throw in here that this auto save. So we've been talking about like automatically defaulting folks into emergency savings programs in the workplace for 15 years or more. But there's regulatory hurdles with that in terms of, for emergency savings, in terms of the employer being able to establish a savings account, an emergency savings account in a worker's name, and then divert part of their earnings into the account. That falls under Regulation E. And I'll just mention that the CFPB has a compliance assistance sandbox policy that employers can fill out an application. Commonwealth Fund has been instrumental in this, but basically it would allow the employer to designate an account for workers if they don't designate one themselves. And so, but that has been a big barrier in terms of defaulting folks into emergency savings, automatic emergency savings.
Yeah, I appreciate both of these sets of comments. And I guess what I would just overlay with is that when we talk about even the instability of economic resources, it's just probably helpful to remind that we're talking about broader labor market conditions where many of these families face hours volatility, within a week. They don't necessarily know how many hours they'll receive at their job. There is more transitioning in and out of employment. So these are working families, but the nature of the work is less stable. And frankly, with the rise in contingent work arrangements, this does raise issues with respect to the portability of the instruments that are suggested. And that employer-employee relationship is just going to be quite different for many of the families that we're hoping to serve. And then I guess finally, I would say that there are misconceptions at times about the nature of the social safety net that's wrapped around low-income families. In fact, by and large, with the exception of the once-a-year refundable earned income tax credits, these families typically don't receive much in the way of meaningful cash assistance. With the exception of the American Rescue Plan, which we may talk about later, which is a temporary one-year deal. But this means then that when we think about the supports that these families have to buffer against different expenses, sometimes perception and reality are not, one and the same.
Thanks, Bradley. Appreciate all of that. I think you've given all of our viewers a lot to unpack and a lot of work for me to figure out where exactly I want to turn. But I think I want to pull on this thread that you all have raised. One, that this employee-employer relationship is changing and that there are misconceptions both of what supports people receive from work as well as the pay. So appreciate that kind of high level barrier of what income actually looks like for households, the number of households that don't actually have a high paying job that provides these types of really important employer provided benefits and supports. And then the other side where we're thinking about the safety net and the role of that, not necessarily matching up with the perception of what the safety net should be doing. So because you just brought this up, Bradley, I do want to pull a little bit on what we saw during COVID. So the American Rescue Plan, the CARES Act, and other support that was passed to provide economic relief in response to the pandemic also speaks to the gaps that we saw in the current safety net, as well as people's personal safety net, their savings in particular. So what lessons have we learned between this response and before it? And does that signal anything for what you hope to see in more permanent packages going forward?
Sure. I mean, I think that, one of the promising aspects of policy response to the pandemic was essentially the adoption of a child allowance program that could effectively reduce child poverty in half. And again, we tend to measure poverty on an annual basis. We use survey data, but the reality is that poverty is sort of an episodic series of events. How you're doing at the beginning of the month might be very different than how you're doing at the end of the month, depending on where your food assistance benefits lie, things like that. Do you not have access to housing assistance, which is not an entitlement in this country, right? One of the interesting things that Sierra spoke to was the notion that she didn't necessarily grow up in a qualitatively great neighborhood. Well, that has all sorts of long-term consequences for families and their upward mobility. So in terms of where we want to go with the safety net, look, I don't want to paint with a wide brush, but I think many of us believe that the safety net should be providing more in the way of actual liquidity, actual cash assistance. And so the American Rescue Plan does have an alternative where families are receiving periodic payments of around $250 to $300, or they can take the lump sum payment. I think there's some families that would like that lump sum payment because they can sort of engage in larger scale purchases, pay down loans, conduct repairs. But I think for other families, this sort of consistent cash assistance is something that they would benefit from. And frankly, it would provide more consistent, stabilization. So, I think that there's opportunities here, frankly, also to pair some financial literacy and some savings instruments for families who do now have maybe some potentially extra resources on hand. I would just say as a cautionary note, the transmission of the ARP, the American Rescue Plan, hasn't been 100%. So we do have to keep in mind that there are knowledge barriers. There are workers who aren't fully attached to the tax system. So there's going to have to be work done to make sure that everyone who qualifies can benefit from this infusion and hopefully save some of the resources.
Maybe I'll just emphasize a couple of points that Bradley made, that the child tax credit, that is close to like this idea. We've been talking about guaranteed income. This is really sort of a guaranteed income for low income families with children. And that he mentioned sort of these ongoing payments, like that's a really novel aspect of the child tax credit. And that this could really be an on-ramp for families, both to save as well as potentially get a product that better suits their needs because they have this more regular influx of resources. So it's just emphasizing a couple points there.
Yeah, that's fantastic. And I think really speaks to this piece that we're saying that if income is going up and down, then how do we address that? How do we kind of build in the liquidity that households need? So I think that's a good place for us to turn to. One, I want to give one last space for if anybody wants to address, are there any other current savings programs, platforms, policies that are not working for folks? People aren't able to access, for example, and whether there is anything else about differential impacts that we should be paying attention to.
Well, I would just raise, and this isn't directly in the wheelhouse of your question here, but it did remind me, there have been pieces of programs like TANF, the nation's welfare program as it currently exists, block granted, where the safety net could provide one-time payments, one-time assistance to basically help families buffer events. And I think a lot of the psych data from folks like Mulanathan and Shafir, and Steve kind of alludes to this, suggests that, when we face sort of big events, this actually does maybe in the moment deploy us of the ability to kind of think longer term. You're kind of trying to solve an immediate event. And so there might be other long-term events that you don't necessarily fully plan for as well, because you're trying to kind of triage and get to tomorrow. And so I do think that as we think about savings, really kind of helping families with these events that occur that, in some respects probably aren't large in qualitative terms from a public policy perspective, but that could really derail these households. Again, things like, transportation expenses and things like that.
Can I just add one other point that's different? I don't think we've talked about, but just thinking about like sort of people's broader finances. We think we're moving to this, moving into this more digital world. So 2 points. So first, like to the extent that like financial apps and digital products rely on our current financial and banking system to function, people who are not well served by mainstream financial institutions, they're not going to be in a good position to benefit. And then also like effective use of these apps and digital products requires reliable, affordable access to the internet. So if vulnerable consumers have interruption in service because they're behind on their bill, or on their phone bills, or they've run out of their data's out for the month, that these financial products aren't going to be helpful to them like they are to higher income folks.
Absolutely. And I think what you all are bringing up are these pieces where we're seeing the data compounding. So issues of income volatility being compounded by having low incomes and low paying jobs, or jobs without benefits, or having expenses that are too high to be covered by income, or all these pieces that are compounded by all of these other pieces that you're bringing up in terms of the platforms, the availability of reliable and affordable internet. And then Bradley, the point that you were bringing up too about the safety net of it not necessarily being an evenly spread, like it is different by state depending on how they are taking in those TANF recommendations or other pieces. Minimum wage varies across states. So there's this very uneven safety net that is laid upon all of the other critical pieces of people's financial lives. So many things for the next panel to be discussing. We are almost out of time, and the next panel will be talking about these saving solutions. So what I would love to do in the 7-ish minutes that we have left is ask you all to address a little bit, what do you want those that are creating or impacting savings policies and platforms to keep in mind when they are designing these types of solutions? What do we need to do to ensure that we actually do have the inclusive and equitable solutions that we hope for?
I can comment briefly on that. So as a researcher and as a behavioral scientist, I think it is essential that we measure outcomes and not just intent. And so as a researcher, my working assumption is that people's intent is excellent and the outcomes are poor. That is what we see again and again and again, that well-meaning, thoughtful people designing products, they end up not having the effect they want. And we see this in the distribution of impact on, for example, workplace retirement savings, sort of safety net, all the things that Bradley was talking about as well, that if we want to improve outcomes for low and moderate income households, we have to measure outcomes for low and moderate income households, and not simply say this is targeted for them. Let's see if it actually works. And sadly, we have many programs that 5 years in, we find that in fact they backfire. That either don't have the effect that we wanted and we put tremendous time and energy into them, microfinance being a massive example all across the world, right? That when rigorous work finally came 5 years in, we found it just didn't work. We find that in some of the specific targeted savings programs. We should assume that there are backfire effects. We should assume that most of the time it's not doing what we want, and we need to measure outcomes, not intent. Oh, and one more thing, read Aspen Institute's Cycle of Savings. Mine was kind of a meta comment. If you actually want to look at the specific programs, helping people with unequal income, et cetera, read their report, because that has the answer.
I can go next. Brad, we are set, okay. So I guess I'll just add on to that a couple of ways. I mean, I think Steve made great points. But when we're thinking particularly about vulnerable consumers and those entry points, like how do we get to them so the employer can be a great place, but really step back and thinking about that population we want to reach and what's the entry point to get them. Also, I would say, like, so if we think about a product and if we're looking for a product, it can be hard to like maneuver through the field of, you know, all the products that are out there. But if we're thinking about a product that can meet consumers' evolving needs, that can be helpful so that you're bundling different aspects that meet consumers' needs. And to the measuring point, so a lot of the studies, like where they can, you know, the evaluations, they're testing something, they're looking at savings. But we also want to look at, do people take on more debt and their financial well-being? So I think it's just not enough to try to increase savings. We need to step back and think about the broader financial picture and also measure that so we can add to our understanding of what's happening beyond just that savings component. And we do know that consumers really want to have savings, and we know that there are consumers that hold high levels of credit card debt and have savings. So the credit card debt is costly. And we did a study at the CFPB last year, and it was a hypothetical lab study, but people on average only were putting about half of their savings, or like 50 to 60% of their savings, towards credit card debt. Even folks who could pay off, you know, would have like, you know, thousands of dollars left. So kind of measuring those broader outcomes are important.
Yeah, you know, I guess I would just echo and say that, you know, given what we know about job instability, job changes, I would say that portability is a question that I'm going to continue to have, and making that really transparent to the user. And then secondly, and I think this really does kind of draw off of Caroline's commentary here, you know, ease of access to benefits and thinking about savings as a dynamic process, right? So that means that defining success might be different. So success here could be preventing debt accumulation, right? So that might look different. And so making sure we're asking the right questions, thinking about the kind of the counterfactual, maybe this looks modest, but how much worse could it have been in the absence of, say, some accumulated emergency savings? So those are some things I'd be looking for, you know, as this work moves forward.
Fantastic. We are running on time, so appreciate all of you. These pieces about portability and thinking about the counterfactual, thinking about the measurements, I think are all going to come up in the next conversation. Thinking about the ways that we can bundle all of this will be really critical. So I really appreciate you all bringing in this holistic picture. Some of you in the audience may have been like, we're coming in for, you know, short-term savings, and we've been talking about the safety net and income and expenses and debt. But I think this holistic picture is really critical because savings don't happen in a vacuum. So we are at time. So let me thank all of our panelists for sharing their expertise and knowledge with us. You've given the audience a lot to grapple with and consider about the ways people build and use their savings, the barriers that they face in trying to do so, as well as the negative consequences that occur when households are not able to have this critical buffer in place at a time when it is needed. So the next panel will be building off of this and digging into savings solutions. So each of you, Bradley, Caroline, and Steve, you can go ahead and turn off your cameras. And to the audience, I invite everyone to take that quick break that Saurabh had suggested and we'll be back in 5 minutes. See you soon. Thanks.
Hello, folks. Welcome back from our break. That first conversation really reinforced the concept of the cycle of savings and the ways in which routinely positive cash flow is an essential requisite for financial security. Caroline Ratcliffe raised important points about the power of defaults and how small amounts can make a big difference. Steve Wendell spoke about the drag that medical and student loan debt can have on savings and how income is the biggest determinant of savings ability. And I really appreciated Bradley Hardy's discussion about expense volatility and how folks with limited savings might need to rely on costly predatory products. Before we jump into the next panel, we're going to show another Save Your Life member video. This time we will hear from Shakira. So we will cue that up.
I entered the tax story contest that Save Your Life ran, and I won the prize money of $2,500. It came at a very unexpected time. It helped me build a savings for my son and I. I'm a single parent of a 7-year-old child. Save Your Life has taught me a lot. The website has tons of information. I was introduced to my own personal financial consultant. My advisor or consultant, he taught me a lot. We went through a lot of information. I was introduced to different programs from him as well. Since learning about Save Your Life, I have improved my credit score 126 points. There's a lot of information. So I've learned things from taxes, about controlling and managing debt, getting out of debt, setting myself up to be financially stable and independent. Save Your Life is an amazing program and you should give it a try.
Alrighty, many thanks to Shakira for that video. It was powerful for me to hear about the impact of a cash windfall, in this case, prize money from a Save Your Life contest. Her story also highlighted the important role that financial coaches or advisors can play in supporting their clients and helping them achieve their goals. With that, I would like to introduce my colleague, Catherine Lucas-McKay, who will be leading our next discussion.
Thanks, Rob, and thank everyone for joining us. I'm loving all of this conversation in the chat and all these questions. So I'm the Senior Program Manager for Insights and Evidence, which is our research team here at FSP, and I'm going to be introducing in just a moment 3 panelists. Fiona Gray is the Director of Consumer Research at the JP Chase Institute. Joe Phillips is the Director of Research and Innovation at Nest Insight, which is the UK broader pension system. And finally, Sid Pila is founder of Sunny Day Fund, which is an innovative saving program. So I invite all of you to turn on your cameras, and we will get started. One of the things that we're going to cover during this panel is how we apply the research findings that everyone who spoke at our first panel to actual product design and also public policies. So the idea here then is to lead into, with our third panel, what the actual solutions out there right now are. And to get us started, I would like to invite Fiona to share some of the information that they have drawn over the past several years at the JP Chase Institute, which is kind of like a think tank within the larger financial institution that provides analysis of consumer finances through looking at the anonymized data in all of the different accounts that they have. They've been able to produce some fascinating data and insights both before and during the pandemic. So with that, Fiona.
Thanks so much, Catherine. Yeah, so we have been obviously looking at account balances, account volatility over the years, and some of the things that we have realized even before COVID was just how volatile people's lives. I think we heard about this a little bit on the prior panel, but you know, we see 30% swings in people's income from month to month, so too with expenses. And what that tells us is that, families really need a cash buffer. They need working capital just like a small business does to meet their, monthly expenses and which may not, match up nicely with their income flows for any number of reasons, right? It could be that one month you get 3 paychecks instead of 2, but the next month you only get 2 paychecks, but that you have your, you have your rent due and all that sort of thing. So we use the data to tell us, well, just how much of a cash buffer do families need? And we estimated that in order to weather a quite stressful event, an income dip simultaneously occurring with an expense spike of 25% deviations or more, an event which happens roughly every 5 years, by the way, families would need 6 weeks worth of take-home income. So that's 6 weeks of income to manage that kind of swing, and that may sound like a small number relative to other benchmarks out there. 3-6 months are usual rules of thumb. But what I think is powerful about this number is that, number one, it's data driven. Number two, we actually know what kind of insurance you're buying. You're buying insurance against an event that we observe happens once every 5 years. Now, why is this cash buffer necessary? Well, it's necessary not just to manage that volatility, but it really matters in terms of people's downstream spending volatility. So for example, we observe that families with more of a liquid buffer maintain a higher level of spending when they lose a job. And that's an income dip. They so too also don't exhibit as large of a spending spike when, say, tax refunds arrive. And that second example it sounds like an innocuous example, but I'll tell you why it's not. One of the things we observed in the data was that after the arrival of a big cash infusion like the tax refund, we see a 60% increase in medical spending, out-of-pocket medical spending. And actually, most of that spending was in-person swipes. That means that people are deferring healthcare until they have cash on hand. And that's not what we want, right? We don't want people going to the doctor when they have cash. We want people going to the doctor when they're sick. So all to say, over the years, this has just really underscored the importance of liquidity, and of course, the racial gaps in wealth, the racial gaps in liquidity drive home the racial inequalities that we observe in spending responses, in people cutting back spending when they experience any kind of volatility, because Black families tend to have a lower buffer. So those are just a couple of tidbits.
Thank you. That kind of fits right into the idea that savings is not just about the income you earn and the expenses you have, but all about the context of your life. And we are going to think a little bit longer term about the context of life now, hearing from Joe Phillips, who, as I mentioned, is the research director at Nest Insights in Elmi. Joe, if you could tell us about your Sidecar pilot that you're doing and how that fits in with partnerships with employers and some of the, I know you're early on in the results phase, but some of what you're learning from that.
Thanks, Catherine. Yeah, I'd love to, and tell me if there's any of this that you'd like to delve into in more detail. So I guess the first question is, what's the Sidecar Saving idea? And really, it was proposed by a group of US academics, and the idea is that it's a hybrid savings tool, bringing together in one place both shorter and longer term financial security needs in one solution, so that rather than there being a kind of tension between two different shorter and longer term financial goals, that tension is resolved in one solution and a saver makes one decision. So the way that it works is that a saver builds up a buffer of emergency savings first, and then when they have that buffer in place, that only at that point do they start saving more for their retirement. And the thing that we're piloting in the UK in the workplace context is a saving solution called JARS. So it's a 2-account sidecar savings solution. It's offered by our partner Salary Finance, and it combines an instant access savings account with a rollover to the workplace pension that the employee already has in place under auto enrolment in the UK. So the way that it works is that the employer offers this as a workplace benefit to their employees. It's voluntary. They decide whether or not to sign up. If they do decide to sign up, the saver defines 2 parameters. So the first is the amount that they want to save each pay period, and that's a fixed kind of pound amount rather than a percentage. And then they also set a savings target that they want to hit. And from that point on, really, it's just set and forget. It happens in the background. Every pay period, the money goes into jars. And first of all, that money goes into the instant access emergency savings account. If they hit their target, it rolls over as an additional contribution to their pension on top of any contributions they're already making. If they were to withdraw money from their emergency savings account that took them below their target, the money would flow back in to build up that buffer again before any more goes into retirement savings. And the saver can change the amount that they're saving at any point. They can change their target at any point. They can make deposits outside of payroll to boost the saving, and they can also withdraw at any time, and there's no kind of penalties or limits on withdrawal. So we are currently piloting that JARS Sidecar Saving solution in 4 UK employers. We're about to see it go live in another employer in the next couple of weeks. And as the research, kind of one of the research organisations involved, we're looking at evaluating over at least a 2-year period what impact that has on people's financial security, their financial well-being, their savings behaviours. It's sort of relatively early days, but we have some early learnings of kind of how both employers and employees are receiving the idea. We'll be publishing a report on this on the 8th of July, so please do sign up for our mailing list if you want more detail than I can give today. But what have we learned so far? I think, first of all, this is an idea that really appeals to both employers and employees. And I think particularly in the sort of pandemic context, the idea of having emergency savings is very salient to people, and we've kind of seen an uptick in interest as the pandemic context has continued. Practically, it works. It's simple to set up for employers. It's simple to use for employees. The payroll deduction part of the product design is really powerful. I think it's easy to underestimate the power of that feature. The fact that I can just set something up and then it just happens, and that the money comes out before it hits my pocket, so I don't feel that loss. I don't kind of have to fight temptation or kind of remember to put savings away. It's just happening in the background. But then we've also seen that kind of set and forget mechanism doesn't mean that people aren't using it. Saurabh talked just now about, kind of using the emergency savings, kind of feeling able to draw down on that and withdraw from it. And sort of one thing we wanted to check was that having this payroll deduction set and forget mechanism doesn't mean that people don't use the money, but we're seeing quite active behaviours in terms of withdrawals, in terms of people changing the amount they're saving, and also in people making ad hoc deposits outside of payroll. So although it's sort of easy to set up and kind of forget about it, people are also using it quite actively when they need it. And then we've seen sort of pretty persistent saving. I mean, below 10 accounts have been shut. When people leave their employer, the savings account is their account, and they can continue to save in it and take it with them even if they no longer have the payroll deduction. So we have seen people leaving employment and not shutting their savings accounts. I think the other really important learning to pull out is, and this kind of sets up, I guess, some of the questions around policy considerations further down the line, is that despite all of that sort of positive appeal of the savings solution, and we've talked a lot in the sessions earlier about people wanting to save, there is still kind of several barriers to people actually getting around to sign up in a voluntary opt-in setting. So although responses have been really positive, the follow through from intent to actually getting around to sign up to save and getting through that process and starting to save, but there's a lot of drop off there, and voluntary take up is quite low. So our next steps are really to look at switching that opt-in approach to an opt-out approach. And as others have said, there are regulatory considerations there, which are just as true in the UK as in the US. But we're working through those at the moment and looking to trial an opt-out approach to joining payroll savings or payroll sidecar savings this year.
Thank you. I think this is so interesting as both product design and delivery channel. We're going to talk a little bit more now about delivery channel, particularly workplace, with Sid, who has founded a really interesting company called Sunny Day Fund. And so Sid, first of all, why Sunny Day? And secondly, why employers? Historically, employers have not really had a role with short-term savings or liquid savings. And you know, it's seen as an opportunity, but from someone who's taking advantage of that opportunity, what exactly is it that makes it so appealing at the moment?
Absolutely. Thank you for having us, Catherine, and I'm happy to talk you through Sunny Day Fund specifically. So before I go too far down about Sunny Day, I wanted to share that, you know, before we went into the product design, we sat down with hundreds of employees across multiple different income segments to conduct the type of research that everyone has talked about thus far, right? So a lot of our guiding principles in design came from them. And along the way, they were active contributors to the actual design of our product itself. So what I'm going to be talking about in a minute is essentially designed by the people that are our users, which is fantastic. So the entire reason behind Sunny Day is one of the things that we learned during our discovery is that people hated the chore of putting money away for a rainy day fund. It did not feel like they felt like it was the right thing to do. It just didn't feel like they wanted to do that. So when we paired that chore of saving towards their emergencies with the joys of other near-term financial goals that they have for themselves, all of a sudden they approached it in a much more lively manner. And as a result, that also increased the level of participation that we had during our early days when we were doing more so the behavioral experiments. And so our brand, Sunny Day Fund, does exactly that. We enable direct from employer contributions, paycheck contributions into a standalone FDIC insured savings account that is in the name of the individual. It is not a custodial account structure, which is very important from a policy perspective that I'm sure that the next panel will talk about, but maybe we'll get into that here as well. And those individuals are actually earning rewards from their employer for their savings behavior, both in terms of their contributions, but also in terms of the balances that they're maintaining. And all the while, there's the psychological reinforcement that's happening because they're saving towards the goals that they have for themselves. Now, why is this all of a sudden relevant in the employer space? You know, why should an employer care about this? Well, my answer would have been very different 2 years ago, but I'm not sure if you have heard about this thing called the pandemic. It seems to be all over the world. And that has shaken up how employers think about it and has also shaken up how employers want to approach a labor market that is the most competitive that I've ever seen it. One of her associates was talking with an employer who runs a lawn care company. And literally, as a person is taking care of the lawn, a competitor was approaching that person and saying, hey, we'll pay you $3 per hour more. You want to come join us? This is the labor market that employers are currently in. In addition to competition for low, moderate, and middle income people for the first time in generations, it feels like, there's also a new push from a diversity, equity, and inclusion standpoint. And employers are starting to realize that they need to peel back the numbers on what their 401k participation actually is. And when they peel that back, what they're seeing is a large discrepancy in by race, by income, and by the amount that people are actually putting in terms of who is actually participating into what is a $250 billion tax expenditure from the US government, right? So all of a sudden, employers are like, okay, I need to make sure that I have workers because I have all of this revenue I'm going to lose out on otherwise. And I'm saying all of these things about why I care about my workforce, and I should actually have some actions that follow through with it. What can I do? That's where we are starting to come in. And that's where we are starting to elevate all of the great work that Aspen has been doing, Aspen FSP has been doing, and elevate the fact that, for example, another research study that came out in April 2021, ARP research sharing that 9 in 10 working adults want emergency savings as a benefit. 9 in 10. When do we get that level of consensus anywhere in the present day world, right? So when we are effectively using this as an intervention point with employers, we're elevating all of the research that you're putting forward, saying, yes, will emergency savings enable financial well-being? Yes, as Saurabh mentioned earlier, that is the #1 driver to better financial well-being. Will emergency savings enable you to attract and retain workers? Yes, that's something that we've been proving out in our own research. And will this program actually increase participation voluntarily? And that's something that we've uncovered in our latest data, where people that are earning $15 an hour are able to put away $40 to $50 per biweekly paycheck. And another way to put that number is someone that's earning $30,000 per year, putting away $1,000, which is a significant chunk of change into their sunny day fund for their emergency fund goal, as well as their other goals. So there's 3 real design principles that enabled us to accomplish all this, going back to that initial piece, which is making it easy, which Joe definitely talked about. And Joe also talked about making it accessible, as in making sure that there's no conditions whatsoever, no penalties whatsoever in tapping these truly liquid assets. And last but not least, making sure it's rewarding. And the employer, in our case, does need to put in an incentive. And it's also the best time to have this conversation because we're looking at a population that finally has the financial capacity to save. With the CTC coming out, with the American Rescue Plan in place and the stimulus checks, we are finally meeting employees and the 152 million American workers, all of them at a place where they're able to save. So I think it's the right time to do it, and we've found a wheel that works.
Thank you. I could not have asked for a better segue into my question, which now is for all of you. Please feel free to chime in. And that is, we have had this enormously disruptive 15 months that we're just really starting to come out of due to the recession and due to the pandemic itself. So what did you learn about people's savings needs and the challenges that they were facing, how the challenges they faced going in affected them during the pandemic? And if you have data or insights on what happened with some enhanced safety net benefits and the stimulus payments in terms of people's capacity to save and just in terms of their liquidity to manage their lives, I would love to hear comments on that. And let's see, who would like to go first? Fiona, you.
Yeah, I was going to jump in just because, we've been watching this really closely. And I mean, certainly, if you just look at checking account balances, median checking account balances across, through 2020 and for the first part of 2021 that we've been looking at, you see, a 70% jump in, cash balances with each round of stimulus. And of course, that percent bump was much higher for low-income families. It was much higher for low liquidity families, in part because they all start with low balances. So a $1,200 check on a $300 balance is a much bigger percent increase on that baseline. So we certainly have seen that the government supports, as Sid noted, have been incredibly important and very progressive in that they targeted a lot of cash, not just in stimulus, but also in unemployment insurance benefits, which we expanded in 3 ways. We extended the duration, we expanded the eligibility, and of course, most notoriously, we increased the level of the benefit to the point that, with the $600 supplement, more than half of workers were receiving more in unemployment insurance benefits than they were when they were on the job. So all of these supports have been, number one, unprecedented, right? It's a very different policy response that the government has had during COVID than, say, the Great Recession, where we focused much more on monetary policy. We wrote down the balances on people's mortgages. We did not necessarily give them cash, but for one check. During COVID, cash has been king. It has been fiscal support has been the way that at least the U.S. government has really reached out, and that's partly because we were already in a low interest environment, right? It's sort of pushing against a string with monetary policy, not much one can achieve with that in an already low interest environment. But I think we've also learned over the years that liquidity really matters and cash flow really matters in terms of the spending response, right? So that it plays not just a sort of financial safety net role for people, but it also plays a macroeconomic stimulus role in terms of people. It boosted people's spending. We saw that very clearly among low-income jobless workers. Their spending actually increased over their own baseline with those extra benefits from unemployment insurance. So all to say, during COVID, this is a really unique moment. I think Sid is right to note that. And it's really important to kind of think about that in the context of savings and savings policies, programs, products, because in a financial life that's going like this, if you're not saving the spikes, right? If you're not capturing those up moments, you're going to be in trouble during the down moments that we know exist. And so thinking about this as a savings moment on kind of a national level, I think is really important.
If I may jump in there as well, Fiona, and I completely agree with saving the spike. I would also suggest to the policymakers that it's not over. And I think that, yes, in terms of the stimulus packages, things are over, but maybe if we can learn from what we have seen over the course of the last 15 months and reflect the data back to those policymakers to help them realize, look, cash is king. So how can we create more sustainable liquid wealth loops, maybe at the employer level, because that becomes a lot more scalable in terms of a solution. And so that's what I would suggest to policymakers that may be on the call, like to think about how can we create the mechanisms that have begun with this round of bills.
Yeah, I mean, obviously sitting in a UK seat, I'm less able to talk about the stimulus packages and the impact in the US, but I think a couple of sort of common things that we've seen are, in the first panel, research was shared. This unexpected financial shock that people have experienced en masse has allowed us to really evidence that protective power of emergency savings at the kind of macro level. But I think we've seen, talking with employees, that's something that people feel as individuals as well, that the idea of having a buffer has become more salient, whether or not people have experienced a loss of income themselves, that they have just experienced more of that in their communities and peer groups. And so we've seen in the context of our research trial that means that the idea of building up an emergency savings buffer is really attractive to people. But I think it's also true that the impacts have been unevenly distributed, and actually the people who most need a savings buffer may be the least able to start saving right now. And so certainly with some of our employers, we've started looking at ways that you might, I think saving the spike is one idea. I think there's also another idea, which is when you feel the need for it, but you can't do it, how do you harness that intent? And so we've been looking at the touch points that the employer has to do that. And that's things like debt to savings pathways, where if I have taken a hardship loan for my employer or a kind of payroll loan for my employer, then there's a moment there where I could pre-commit to turning that into a savings payment when I've paid off the loan. There's a communication moment there when the loan comes close to being paid off. So I think we're really conscious that this is a savings moment, but it's not a savings moment that's accessible for all savers. And what can we do behaviourally, structurally, and what can employers do to support that so that moment it kind of turns into the potential for a savings habit.
That is also really interesting. And particularly, for just contrast with the US system, where if you can get a retirement hardship loan or a business, workplace hardship loan, there's still, anything that touches retirement has almost like a just purely punitive policy framework around it. And hearing about ways of, thinking forward about once someone has experienced a hardship that required some type of real financial assistance, what does it take to help them get back on track? That I think is so interesting. So another question that I have for everyone is, what do you see as some of the key lessons? I know some of them have already come up, but key lessons for policymakers for business leaders, and also for employers in terms of what can their role be and what should their role be in supporting emergency savings and more broadly liquid savings.
I'm happy to answer that one. We'll have a first crack. I think we have seen employers increasingly recognize the business case for supporting emergency savings amongst their employees. You know, the evidence is really building around the reduction in money-related stress, the positive impact on productivity, on retention, some of the things that Sid talked about and that, you know, are modeled really nicely for employers by Sunny Days. I think certainly in talking to employers, I see that, you know, that they're looking for a solution to that, and so there being options in the market to support that is really important. I think as well for employers to know their power, to know the power of payroll deduction, to know the power of the reach that they have, you know, reaching people who may not ever have had support or kind of been able to set up a savings account. And we know that even just setting up a savings account creates conditions that are conducive to savings. So, you know, that there's a real power there. And then I think where employers are offering ways to support emergency savings, just to make sure that we are celebrating and rewarding the behaviours that matter. And I think we've talked a little bit about incentives. And I think, you know, if we think about emergency savings as something you do and you use rather than building all the time, you know, that emergency savings only works as a tool if it's used, but actually rewarding people who save regularly and persistently rather than rewarding a balance, actually celebrating when people make a withdrawal and that withdrawal is protective and protects, you know, the other places they might have gone to cope with that shock. And just one on policymakers, because we're deep in this at the moment, is just looking at ways to remove the friction for employers and providers to support saving, including opt-out rather than opt-in approaches.
I'd love to add on here. So from the employer perspective, there's three very compelling ways they can do this, right? Again, if we're taking inclusion and equity as the ways that we want to engage the employer, you know, social contract going forward, we have to get to a point where, at least in one way, liquid savings or otherwise, we have to get to 100% penetration. And when we're looking at 401k loans, 401k hardship withdrawals, the companies that we're talking with, their plan participants have 20 to 30% hardship loans and withdrawals against them. That we need to come up with a way to balance that, whether it's through the sidecar savings approach that Joe's working with salary finance, or you know, with something like Sunny Day Fund, where we act as the liquid cash buffer. Beyond, and I think I saw Josh mentioning the experiment in India about like how that works to protect their retirement savings as well. In addition to that, I know that we mentioned this during our prep call too. There's a lot of employers that are actually sitting on a good bit of cash reserves, especially if they are a self-funded insurance, and that is about 1/3 of companies out there. And those excess contributions that have just continued to build up in general assets can be tapped into to be returned to their employees in this approach. So like you can restore the economic incentive for those individuals that want to contribute to emergency savings by saying like, sure, it's a matched approach or rewarded approach, whichever way you want to go with it. If you flip that over to the policy perspective, then it's exactly as Joe said, remove the friction. You know, some three specific things that they can do over there is, you know, we talked about in the last panel, the CAS template issued by the CFPB and powered by Commonwealth. Well, that is still requires that all employers are provided consumer choice. While I completely respect consumer choice, consumer is not getting much choice with retirement savings at the end of the day in terms of who the provider is. So it is a little bit of a double standard but it improves the scalability and the cost of addressing this problem from the employer perspective. So that's something that the policymakers can certainly look at. Looking at how employers or policymakers can potentially incentivize employer rewards that are paying out. We talk about that $400 number incessantly. I feel like anytime we have these conversations, it at least comes up 3 or 4 times that a lot of too many Americans can't handle a $400 surprise expense. Well, what if the government said, hey, employer, if you're providing $400 in rewards to your employee that is putting away for emergency savings, you don't need to pay payroll taxes on that. That, even if it goes across all 152 million American workers, it ends up being only a $5 billion program compared to the $250 billion on the retirement savings side. And the third element is just normalize it, right? If we establish that it is okay for employers to address liquid wealth as a benefit and normalize that as an expectation from a policymaker standpoint, I think we can accomplish so much impact.
I mean, I'd raise that, Sid, not just for employers to address and recognize liquid savings as a benefit, but for the federal government to do that. And I think that's a provocative innovation that came through during COVID, right? Was that we set aside our paternalistic ways and just gave people cash directly, right? And that was powerful because that allowed us to, number one, target the relief really quite well. In terms of delivering cash to particularly to low-income families, phasing that out. Over time, we actually did a really nice job of delivering more cash directly to children, right? By increasing the amounts that went to children, not just adults. So that as just sort of a framework with which to think about any number of downstream things, right? Like asset limit tests. You're saying let's not tax assets. So I'm also saying let's not create asset limit tests in terms of other benefits, right? You can imagine sort of if you were to think about liquid assets as a social safety net in and of itself, private liquid assets, that has lots of implications for how we screen and establish eligibility for any number of programs, given that if we establish that as a policy goal. But I also think we learned a lot about the plumbing, the pipes of policy during COVID, and that these national infrastructures like, the tax code and the tax refund and direct deposit payments that we can make. Nobody spent, I took up a hobby, which was, to start looking at the daily treasury statements of how much the government was giving out through various different programs on a daily basis. And one thing that you discover is that they got a lot quicker from payment to payment to payment, from stimulus to stimulus to stimulus. A much larger share was, but by the third round, sort of 95% was paid out within a week. And that was a week or two after the ink was dried on the policy, right? So of course there was lots of negotiations, but by the time the decision was made, it was days until people had cash. 95% of the recipients had cash in their bank accounts. That's extraordinary in terms of like just pure plumbing. And you contrast that with state policy and the ways in which so much of our social safety net and the ways in which we deliver supports to families is federated, unemployment insurance being a prime example. We asked states to stand up a new program, the Pandemic Unemployment Assistance Program, to gig workers, people who were, caring for kids with COVID or, people who had limited work histories. And it took them, 6 weeks to start even issuing the first payment. And you see this very clearly. We see it very clearly in the data in terms of just how large that first payment is, because there was such a delay between when they finally got that payment and when they had applied. So thinking about the federal government as, potentially a quick, I'm probably the first to say on a panel that the federal government can do things quickly, but they can do some things quickly. And that's something we learned in COVID.
Yeah, I mean, that is a great point about how much faster it got. Certainly I was not taking up the Treasury daily statements hobby with you, but I was noticing both from news coverage and from, our own finances, like Oh yeah, that went a lot faster, especially by round 3. And I think that there are some interesting lessons there, especially we're going to learn more as the child tax credit payments start going out. So we are just about at the end of time for our panel. I want to thank you all. This was super interesting. I think we brought together a really great constellation of thinkers and people from different pieces who are all going to be part of the solution to this challenge, and across the ocean too. So with that, I'm going to turn it back to our hosts, and I believe that we have a quick break and then our third panel.
And hello again. Thank you for sticking with us today. I hope that today's discussions have provided you with important insights and perspectives. Some things that stood out for me in that last panel were Fiona's comments about the impact of cash infusions and the remarkable speed of policy. As she said and Sid repeated, cash is king. It was also great to hear from Joe about the Nest Jars Sidecar Savings pilot in the UK. They're seeing early results of people participating, but just as importantly, they're seeing people withdrawing those savings and using them when they need it. Joe also made an important point that we need to remove friction and make savings moments more leverageable for everyone. And Sid talked about the importance of participatory product design, and it was insightful to hear from him about employers thinking of benefits like Sunny Day Fund to compete in the current labor market. Sid really emphasized that solutions should be made and make savings easy, accessible, and rewarding, and I couldn't agree more. Now, we'd like to show you a third and final video from Save Your Life member, Kimberly.
What about Save Your Life has helped me save is it encouraged me to do the $5 thing once a week. Now that's automatic. I have an automatic chunk of my paycheck that goes into my savings account, and I reached diamond status, and it's kind of like little bits of good stuff. Keeps me coming back to Save Your Life is that Save Your Life is trying to help, and they're doing a good job of it. What specific features help me save and how have they impacted me? The specific features would be just the gamifying of it. And the impact is that I almost have enough to do the full $6,000 on my Roth IRA, which I'm very proud to have. So thank you very much.
And thank you, Kimberly. It was important to hear Kimberly speak about the impact of a regular savings habit, the power of automated savings. She also talked about the importance of product design and how she valued Save Your Life's gamified experience. Kimberly's story really drew the important connection between short-term savings and long-term financial security. So to dive into that connection a little bit more and talk about the importance of automatic savings, I'd like to call my colleague Karen Andres, who will lead our third and final panel. And I'll also like to call in our panelists, Shai, Josh, and Melissa.
Great. Thanks, Saurabh, and thanks so much to everybody who's joined us so far today. We're the final capstone of the show here, talking about emergency savings. And like Saurabh said, this session is really going to build on a lot of what's already been said, especially keying off of what Kimberly just shared. I mean, she went right to the heart of the issue around automaticity, right? That and what Steve Wendell said, he broke it down nicely in that first discussion around some of the barriers to emergency savings can be financial, and some of them can be behavioral. And I just want to frame that what we're going to be talking about today is how do we make one particular platform for emergency savings, the workplace, how do we make that more automatic? Now, that is not obviously a fix for the cash flow piece, right? Income sufficiency or income volatility, which several of our prior panelists have drawn attention to, rightly so. And it's also not a solution for every kind of worker. Bradley Hardy in the first panel really underscored how important it is to think about all the ways that people work. And I'm going to be looking to Josh Gottbaum in a second when he talks about what he's working on, because increasingly workplace savings platforms for retirement are acknowledging that not everybody works in a one employer full-time capacity, right? And so I think we're starting to see more flexible platforms get built. But so right now we're going to dig into sort of the policy barriers and opportunities to automate workplace emergency savings in the United States. So I am really excited about the group that we have pulled together. So first we have Shai, Akabas, the Director of Economic Policy at the Bipartisan Policy Center. Thanks for joining us, Shai. Good to see you. Next, we have Josh Gottbaum, the Chair of Maryland Saves. And Josh is also a guest scholar at Brookings. And then finally, we have Melissa Sanchez, who's a policy advisor in the office of Senator Cory Booker, to talk about sort of the policy landscape and what's in front of us in terms of emergency savings. So I'm going to begin by asking each of our panelists to sort of share what they're up to on the issue of emergency savings. And I think I'll go to Shai first, since I announced you first. Shai, tell me a little bit about the work that you have been doing and are doing on the issue of emergency savings and why.
Sure. Well, thanks, Karen, to you and to Aspen for having us here for this discussion today. It's the work that Aspen's been doing on this issue for the past several years has really been terrific. An issue like emergency savings sounds so simple. People need to save, but there's a lot more to it, as we've heard throughout the conversation today. At BPC, we have really been working on this to try to bridge the research world with the policy world. And our work on this started back in 2016 when we put out a report from a commission that was mostly focused on retirement savings. It was led by former Senator Kent Conrad and Jim Lockhart, who was a senior official in the Bush administration. And they came out with with recommendations on everything from 401ks to annuities to Social Security to financial literacy. But one small piece of the report was thinking about this linkage between short and long-term savings. And I think over the last 5 years, this space has evolved so much thanks to the great work of Aspen and the work of many other organizations like AARP and Commonwealth and BlackRock, which has put a major investment into this area. And we're at the point today where it's really exciting that there is now action both in the private sector in terms of innovation and the marketplace there, as well as in the academic community. And then also, as we'll hear from Melissa, on the policy front. So BPC has been trying to meld these pieces together and think through how we can take advantage of the moment we're in today, because not only is there action going on in all of these places, but coming out of the crisis that we've been in for the last year plus, we now have a moment where we can think through where do we go from here and how can we be more prepared for the next time some type of event like this happens. So combining the situation we're in today with all these already existing factors creates a lot of momentum for hopefully action this summer. And that's where BPC is trying to play a role in helping to get something across the finish line.
Awesome. The summer of emergency savings. We're about to enter it, right? Josh, I'll go to you. Tell me what you're up to in emergency savings.
Okay. You already mentioned the fact that people who worried about the fact that there was no retirement savings for about half of America. For about half of America, the retirement system works very well. For about half, it doesn't. Most of the reason for that is that they don't have workplace savings. And we know that the easiest way to get people to save is just to have it done automatically as a deduction from their paycheck without them having to go to a bank and fill out forms and make decisions and all that stuff. So that effort was underway, as Shai mentioned. And at the same time, people realized that if you're going to go into and establish a new mechanism for workplace savings, should it really be only for retirement? And for a long time, the retirement people said yes, because we don't want people taking out money from their retirement accounts just because their car engine died or something like that. And so there was first an ideological issue. But fortunately, thanks to the efforts of all the people that Shai mentioned, there has been a growing recognition that you actually need to do both. And so I chair a program in Maryland. The first stage of this, the idea of automatic workplace savings as a requirement on employers was thought up by Mark Every and David John, both of whom are affiliated with the Aspen Financial thing. But at the time, Mark was at Brookings and David was at the Heritage Foundation. So this was And their idea was require employers to sign up their employees. The feds unfortunately dithered on this, but the states did it. And so now in 3 states, you already have, in Oregon, Illinois, and California, you have about 300,000 people who are already saving for retirement because their employers signed them up. Now, the important point of this, and Karen will come in and say, yeah, but it's not quite there, is that every single one of those programs actually has an account that can be liquid. And it wasn't designed to be liquid. It wasn't designed to be an emergency savings account, but it was there, and it is there. In Maryland, we're going a step further. I chair the Maryland program. When we get started, I hope by the end of the year, we are going to have a program which is not only liquid, but unlike the programs that have gone before, it's going to pay a 1% rate of interest, because most of the existing rainy day programs didn't pay very much because money market funds didn't pay enough. So what we're trying to do is stand on the shoulders of people who came before and make it easier for employers to sign up and therefore make it savings. The one additional thing that I would mention, because I do think it's important, is that when Mark and David came up with the idea, they thought we should require employers to do it. In Maryland, because it was negotiated on a bipartisan basis, there's no penalty for employers not to. Instead, the state of Maryland says, we're going to pay employers if they automatically enroll their employees. That's what we're going to do. And as it happens today, not coincidentally, Brookings just published my suggestion that if we can't do a stick, why not do a carrot? Why not pay employers nationwide through the tax system to automatically enroll their employees in both a retirement savings account and an emergency savings account? If we can do that, if we can pay employers to do it and not get them tied up in regulatory underwear, then the 50 million people in America who don't have workplace retirement savings could have both retirement savings and emergency savings.
Thanks, Josh. And that was a nice primer on the growing innovation at the state level in the auto IRAs, right? Workplace retirement savings rather, for small businesses. And I would encourage folks to read what you wrote, because I think it's a nice introduction if you're less familiar with the retirement side of this. I think what's interesting is that you're adding emergency savings to it in a separate bucket, which is really a first to my knowledge in the auto IRA space. So thanks for that introduction. Melissa, can you share with us a little bit about your and Senator Booker's work on emergency savings?
Absolutely. So thank you again for having me in this great panel. And I think Josh did a great job of sort of like outlining, the problem of the lack of retirement savings. And, I think what concerned Senator Booker back when he joined the bipartisan group I'll talk about in a minute is, like Josh said, that those who do have retirement savings are, when they find themselves in front of a global pandemic without these savings, or rating those accounts, and for every dollar that's leaked in those retirement accounts now, that means further financial instability when they're getting ready to retire and getting ready to to cash in those savings they're supposed to be building over a lifetime. So that's why in 2018 Senator Booker joined a bipartisan group led by himself and Senator Young, and with the help of some folks on this call, to introduce a bipartisan. Oh, I'm sorry, that's my dog and baby toys in the background. I apologize. That's why we have this great, beautiful background of cherry blossoms, New Jersey, to take us away from the fact that I'm in an open concept apartment. But so yeah, we joined this bipartisan group to introduce a series of bills that I'll maybe just mention at a very high level, and I know Shai will probably get into them in a second, but sort of address the workplace savings component, but also, in a broader scale too. Senator Booker leads the refund to rainy day. She probably should, to be honest. this component that's not on the employer side, but on the individual side. So the first, this one's led by our colleagues in our Young, is the Retirement Security Flexibility Act, which creates what we call a sidecar. This one expands the automatic enrollment and incentivize those incentives for employers to, offer the automatic escalation and enrollment pieces for the retirement savings. The second bill that we work on together is a sidecar bill that creates a sidecar onto a retirement savings plan and includes a pilot program to incentivize employers to provide that to their employees. And the piece that my boss leads is the Refund to Rainy Day Savings Act, which is a bill that allows individuals at tax time to take their refund, and instead of putting it on expenses that they are having in that moment, which we know is tax time is a huge piece of their assets for the year, to encourage folks to roll those over into a savings account. So later on, when they have a tire they need replacing or some other sort of emergency going on, they have that in an account. And so I think, at a really high level, these pieces are part of Senator Booker's, broader work in financial security. I was listening in the second panel that we just got out of, and thinking about, the transformational sort of things that we've got done in terms of the economic impact payments and the child tax credit that's going to be rolled out, over the next few weeks. And, I think that those sort of pieces that really address the income variability that folks are facing, but a big part of that too is the high cost of the wealth gap and racial inequality in particular. And so I'm feeling I'm talking for a long time, so we can always circle back to some of these pieces. But we Senator Booker has been really focused on the issue of the racial wealth gap and the cost that not only for individuals and for generations of families, but for our country as a whole. And that's why he also, in addition to these retirements and pieces and emergency savings pieces, he's introduced the American Opportunities Accounts Act, or what we call baby bonds. To really address, at a really high level, some of these things that we're talking about.
Yeah, thanks, Melissa. And I think it's important. I mean, what I take away from hearing you talk about Senator Booker's priorities on emergency savings is that he sees it as part of a whole, right? Part of they sort of can't separate emergency savings from longer term wealth building, right? And so I actually want to turn to that before we get to the part about like what policy solutions we need, or what barriers we might need to take down to see automatic emergency workplace savings at scale, or workplace emergency savings at scale. I want to talk about two of the things that we have heard historically about emergency savings. So one is that emergency savings might compete with or detract from retirement savings balances. And the second is the private sector can take care of this, or the private sector will take care of this. And I just would love to take your all's temperature. Anybody who wants to jump in on either of those, where do we stand? Is that still in the atmosphere? Is there more that we need to do to sort of present evidence, to the contrary, if we think that's true? Josh, it looks like you might want to jump in.
Speaking as a person who spent most of my life in the private sector, the private sector savings institutions work really well for people who have a lot of money. They work less well for people who have less money. And so our retirement savings systems work really quite well for, frankly, people like us, okay? But half of America gets served less well. And so it is not that the private sector can't provide service, it's that every incentive they have is to provide service to the people who have the most money. So the trick here is to actually find ways at relatively low cost to enable people to save. And that's why so for example, the reason why I proposed today that we pay employers to automatically enroll their employees is because there's not a lot of evidence that a lot of businesses are going to spend $100 or $200 or $300 to set up an emergency savings account. But suppose we said we'll have a program which will make the cost of that sign up is $300, and we'll give you a check for $300 for the first couple of years just to get it going. I think thanks to the combination of financial technology and some smart thought and policymaking of the kind that you heard from Senator Booker and others and Shai, et cetera, I think we can actually make the financial system work for the rest of us too.
Thanks,
Yeah,
Josh. Shai, what do you think?
I totally agree with what Josh said. I think the evidence on both of the fronts that you've laid out, Karen, is pretty clear. On the first, in terms of the linkage between short-term savings and retirement savings, there's been research that we know that leakage is a problem out of retirement accounts. And there's been clear document that once you start taking money out of retirement accounts, that drip turns into a gushing. And anything that we can do to help people build up that buffer so that they don't have to dip into that is actually going to protect retirement savings, not detract. So that's the first point. On the private sector piece, I don't think we need to go too far and say that this needs to be a heavy-handed government intervention. The private sector is already making progress in this area. Commonwealth, the organization, has been doing a lot of work with record keepers and plan sponsors and talking to them about experimenting in this. And frankly, many of them are already underway. So this is happening. It's not like we need some event to kick it off, but we do need some policies in place from the federal government, first of all, to clarify regulations. And I know we're going to talk more about that so that employers and record keepers feel comfortable getting into this area. And then potentially, on what Josh is saying, some fairly low cost and efficient financial incentives to get the private sector moving more aggressively, more quickly in the right direction. So again, it's not a government takeover of the emergency savings system. It is a private sector led effort, but there are policies that we can put in place to make sure that the private sector feels comfortable moving forward in the right direction and to help nudge that along.
Great. Melissa, anything that you want to add to this before we turn to some of the enumerating some of the barriers that currently exist?
Yeah, I again agree with Josh and Shai. I think I just add that I think part of what I just talked about too, and our approach to this is that we know there's not just one solution, right? That the workplace option is one out of a series of different options that are on the table and that should be explored and will be and I think that in future legislation be considered. But I think that there's an issue of in terms of like banking and access to banking, especially for low income folks. And so this is an important but not the only solution that I think that we're all pushing for.
Yeah, I think it's a critical point, Melissa. And it's actually a really nice transition. And I'm going to do something weird that we don't often do at Aspen, but I'm going to actually share my screen. And I know Josh is laughing. A couple of slides. We're actually going to be publishing later this summer a brief meant to provide an overview into the issue of emergency savings policy and why it matters and what the opportunities are. And I want to give you guys a little bit of a preview, mostly so you share it with all your friends when it's published. But no, I think it actually provides a nice framework for us to talk about just some sort of give you a sense of a little bit of the complexity involved. So bear with me while I attempt to share my screen. I can't believe it's the pandemic and I'm still struggling to share my screen. That's how you know I'm actually a Gen Xer. Okay, so I don't need to spend too much time on this, but I will say that all the evidence that so many organizations have done point to a number of important design features, but there are three big key ones, right? In order for an account to work, to be an effective emergency savings vehicle for someone, it needs to be automatic, right? In terms of both enrollment and replenishment, right? That critical up and down line, that is the indicator of success in emergency savings. It needs to be liquid and accessible, right? That their emergency savings are effective when you can access them quickly and easily. And as several people have said, and I think Josh, you've said this before, like the private sector is working. It's the payday loan industry, right? High cost credit is the private sector solution for too many Americans, because without liquidity, people do have to turn to other sources to cover those expenses. And then finally, critically, for a really effective emergency savings tool, it must be designed for that mental accounting, whether you call it buckets or envelopes or pockets or wallets. The brain likes the idea that this bucket is for that and this bucket is for this other thing, which is exactly what Josh said, right, about why he and his team have designed Maryland Saves the way that they have. Now let's see if I can get this to, okay, good. Okay, so what I'm not gonna do is go into a treatise on Regi or know your customer regulations here. the point of this is to show that there are down the left hand, that far left column, that there are many different flavors here. There's like a Baskin Robbins of 31 flavors of workplace emergency savings, right? There are different ways to do this, whether it's inside of a retirement plan and thus subject to ERISA, or potentially could be subject to ERISA. It's sort of adjacent to the plan offered by a record keeper on that same platform. Payroll deduction into a depository, so a bank or a credit union, and then you're in the world of Reg E, KYC, potentially state wage garnishment, right? Payroll deduction to a payroll card or a prepaid card. We're seeing all of this innovation kind of bubbling up in the marketplace, or you're hearing folks say they want to do this, but they're bumping up against some of these regs that are, or policy frameworks that are designed for other purposes, important purposes, right? But in order for us to sort of unlock the innovation that kind of wants to happen, at least that's sort of our read of the environment, we're gonna have to wrestle with these. And I do want to note, and I believe Caroline talked about this, that there is now sort of a regulatory sandbox for depository payroll deduction so automatic enrollment by payroll deduction into a depository account or a payroll card with sort of liability protection around Reg E. So progress is being made, but this is sort of a way to conceptualize the variety of barriers and also the variety of innovations that are springing up in the marketplace. So in addition to thinking about the barriers that we maybe want to modify, right, to allow these accounts and tools to kind of blossom, there are some longer term opportunities that I think, and all of these have been mentioned in different ways, that would make emergency savings more effective and more equitable. And first up would be the asset limits on public benefits. I know not everybody may be aware that even a small amount of savings, a relatively small amount of savings, can render someone ineligible for important public benefits and family supports like SNAP. And we want to think about, gosh, if emergency savings is as powerful as we think it is, and the evidence shows that it is, why do we treat it so differently from retirement savings? Should we incentivize it in the same way for employers, whether it's tax incentives or what Josh is saying, right? Straight up pay them, right? Compensate for enrollment, or incentives for employees, given the way that emergency savings support financial health and well-being and protect retirement savings. So these are some of those additional dimensions of a policy framework that we might consider when it comes to helping emergency savings reach scale, helping automatic emergency savings reach scale. So let me pause. I want to open that up to all of you, Josh, Shai, Melissa. What sort of speaks to you? When you see that sort of grid with the barriers, what does that mean to you about where we go from here?
I think you're already seeing people recognizing the problem and trying to deal with the barriers. Mark Avery and David John, 15 years ago, said, yeah, we have designed ERISA in such a way that half of America won't get to use it. So let's do something else. And so they turned to IRAs. It was a very smart idea, and we're beginning to see fruit. In that case, what they had to do was hold at bay the desire of people who already had retirement regulation to stop this before it started. And fortunately, thus far, the government hasn't been as helpful as it might be, but it hasn't stopped it. So I think you're right to raise the issues. The ERISA one, I know, I'm hoping Shai, who has his finger in 106 pies, knows enough to talk about Reg E, or Melissa. But I think the point that you're making is a general one, which is we are trying to solve a problem we know that is widespread. It's not just 5% of America. It's not just 10% of America. It's almost half of America can't make an emergency payment. And so the real trick is, can we modify existing institutions to solve this problem? Or do we have to do the much heavier lift to create new institutions? I'm in the category of let's find the old wine and put it in new bottles.
agree with Josh, and summarizing that chart that you put up, Karen, I don't think the details are particularly important for every average person to understand, but what the main takeaway there is that there are regulatory impediments that exist today. So not only can the federal government be doing things that could help emergency savings, but just getting out of the way and making sure that there aren't unintended regulations that are prohibiting innovation and new approaches in the private sector. It would be an amazing first step. And that's really where Senator Booker's legislation comes in, which is it's not trying to dictate how this is done. It's not trying to require anything. It's just saying these other policies that are in place, have been in place for many years, things like state wage garnishment laws that prevent employers from automatically putting money in a particular place, or know your customer laws that prevent someone like an employer from automatically opening up an account for you. These are not intended to be impediments to emergency savings. If all we're talking about here is giving people an account that they have access to at any time, that they can use for any purpose, it's basically like their own bank account, but it is labeled for emergency savings, and you're helping them put money into those accounts. There's no reason why, within reasonable guardrails, employers should not be able to help employees do that. They can always take the money, move it out of there, do whatever they want with it. But removing those unintended barriers to those types of uses by employers, particularly for automatic enrollment, because we know the power of automatic enrollment through retirement savings. We know being able to do it through the workplace is effective. If we look at retirement savings, everybody has the ability to, almost everybody, we talked about the unbanked earlier, but almost everybody has the ability to go in and open up an IRA. Almost everybody has the ability to put money into a bank account or a savings account. But the vast majority of people don't do that on their own. And so we need to put in place the structures through private sector with government support to allow them to effectively do that. And these are the types of ways, through the workplace, through automatic enrollment, that we know that can happen.
Could I add one?
Oh,
sorry, go ahead. No,
I was just going to tee it up for Melissa to see, given Senator Booker's priorities and what you're working on, any reaction to the complexity or lack thereof. Maybe it's simpler than we think to solve for some of these issues.
I think Shai sort of spoke to it really well. I think also like thinking about, as Shai was talking about unintended consequences, is thinking about the asset limit issue, for example. It's like another piece of federal policy that we sort of see is like totally unrelated, but ends up pushing the lowest income folks just further into poverty, right? And doing basically accomplishing the exact opposite of what we're trying to do when we're creating these social programs. So Senator Coons has, and that we worked with him on the Asset Act to eliminate these things. But again, it sort of points to it is sort of a complicated web, but there are many different ways to sort of poke at these issues and to make progress there. And I'm really hopeful, and we can talk about this I guess later on, but I'm really hopeful about the movement and the the priorities of the finance and health committees and to make some progress on these things.
Josh, sorry I interrupted you.
No,
Go
not
ahead.
at all. Can I say something nice about Senator Booker, even though I don't work for him? One of the things that has become clearer and clearer and clearer is that inequality in America is a function as much of wealth as it is of income. And I have colleagues at Brookings, Richard Reeves and Chris Pulliam and a whole bunch of others, who are beginning to document how powerful this is. And one of the reasons why I thought Senator Booker's idea of baby bonds and working on the notion of establishing wealth is because he realized that the way to deal with inequality is not just to focus on income. It is to make sure that the inequality of wealth is dealt with as well. Now, I personally am hopeful that what Senator Booker knows becomes sufficiently widespread understanding that we very naturally say, maybe there shouldn't be an absolute prohibition on having any money in the bank at all before you get food stamps. Maybe there shouldn't be a requirement that you spend down to virtually nothing before you get Medicaid. And so what I'm hoping is that what is currently Senator Booker's understanding, which is the importance of wealth, will gradually affect how we think about all these programs, and that we will get to the point where we will say, our goal in life is not for people to be completely broke before they get the safety net. Our goal in life should be that they should be able to have some wealth and still be in the safety net.
Yeah, and I think that, you know, the truth is too, we say this a lot, is, you know, income is what helps folks get by, but wealth is really what helps do the really big things in life, right? It helps you go to college, it helps you to buy a house, start a business, and to retire, right? And folks throughout their lives are, with the high cost of rent and high cost of food and childcare, they're barely making it by income-wise, and they're certainly not able to make meaningful steps towards, you know, that kind of asset building they need in order to have a secure retirement. So these are absolutely separate buckets and, you know, separate issues that really need to, you know, be addressed in a thoughtful way. So thanks.
I would just add very quickly that I don't think we're going to get the two parties to agree on the question of asset tests anytime really soon, but I think a specific area there where there is an opportunity is to tease out this point that Josh is making, which is we are simultaneously trying to encourage people to save, and especially on the Republican side of the aisle, there's a desire to get people to save through the private sector and take their own opportunities to put money aside for themselves. And then the public sector, the government, is disincentivizing that saving by saying, if you put aside more than a couple $1,000s, we're going to kick you off of any programs you have. So it's sending very mixed messages. And there are tailored policies that we could think about as at least first steps to tackle this issue that would exempt a certain amount of savings, whether it's for emergencies or in 401ks or IRAs, from those asset limits, because that won't solve the whole problem. That won't address the two parties' differences on the issue. But at least we should be able to agree, if we all think people should be saving for themselves and putting aside more money, pulling out the rug from them with their government benefits is not the way to get them to do that. And we need to think about how those policies interact together. So that's the first step I would suggest we can look at in that area.
So Shai, I'm actually going to go back to you and say, you know, more broadly, I think it was Sid on a panel who said, you know, this is a moment for emergency savings, and we know that there's activity, right? In fact, Senators Langford and Bennett introduced, I think it was last week. Was that just last week? I think a bill on emergency savings. Shai, could you just give us a sense of like the landscape of emergency savings activity that feels relevant to this conversation and sort of what we might expect next over the next few months?
Sure, it's been a little bit of a trickle. You know, Senator Booker and Senator Young and that group are really the first ones engaged on this at the federal policymaking level, I think, as a specific issue. But as you mentioned, Senators Bennett and Langford have a new proposal that would allow you to take, I believe it's $1,000 you've contributed to a 401k and use that as sort of a liquid pocket. So as Josh was talking about, this is a little bit like what some of the states are doing, where the first portion of it can be removed in case of an emergency in the state plans. So we can have a long discussion about the merits and drawbacks of this idea in particular, but the main takeaway I have here is that more members, especially members who are really thoughtful on policy like Senators Langford and Bennett, are getting into this space and acknowledging that we need solutions. So in my mind, it's the let 1,000 flowers bloom strategy. It's much better to have these bills out there and have people talking about this and figuring out which ones make sense and which ones don't, than it is for us to be, you know, criticizing particular bills right out of the gate. And so I think bills that are well-intentioned, that have a chance to solve a portion of this problem, are worthy of discussion. And I think we're going to see more of that as we move forward. We're already seeing with Secure 2.0, which is the retirement legislation that is the follow-on to legislation that passed in 2019, moving on the Hill. It was marked up in the Ways and Means Committee and passed out of there in the House. I expect that that is sort of going to continue to move this debate forward over the course of the next several months. And there may be an opportunity later this year to get legislation across the finish line that could include some of the pieces, whether it's Senator Booker's bill, the Langford-Bennett bill, other proposals that come down the road, to really not only think about retirement savings, which is the main purpose of this package legislation, but the interaction there with emergency savings.
Mm-hmm. Great, Josh, I see you smiling. Did you want to jump in there on any of what Shai said?
No, I just want to say how nice it is to hear someone as plugged in as Shai from the Bipartisan Policy Center, both giving us realism and saying that there is motion and there is increasing realization. Because the thing that I've learned from the retirement side is that they operate from consensus, and it takes forever to figure out what the consensus is. So this problem is not going to get solved this year. But if places like Aspen keep on focusing on it, and if people keep realizing it, what you will get is you will get a variety of measures. You will get a loosening of the ability to put a emergency savings account into a retirement account. And my view is put those all together and we'll make a dent. And that dent will improve the lives of tens of millions of people.
So here's a bit of a sort of left field question. In the retirement savings space that many of us sort of straddle, right? We've got one foot in retirement savings and one foot in emergency savings. The opportunity of expanding the savers credit and making it refundable has emerged as a way. I mean, it's not new, right? That idea's been out there, but beginning perhaps more serious consideration about whether that should be introduced as a way to not only expand access to accounts, but get more money into those accounts, right? Should we be trying to appropriate some of that for emergency savings? Should emergency savings be the first bucket that gets filled before the retirement savings? Are you, have you, any of you given this, where is this on the horizon, or other ways to get more money into the accounts, especially for lower income savers? Any thoughts or responses to that question?
Shai, you want to go?
Happy to, but defer to you if you want to jump in first.
Well, I think it's important. We are gradually realizing what Mark Avery and David John realized 15 plus years ago, which is that automaticity and employers turn out to have an incredibly powerful effect on savings. So personally, I do not want to diminish the effort to make the savers credit more effective by making it a match, by making it refundable, doing all that. I think those are important things to do. But I think the important realization that more and more people are getting is that the ideal complement would be to take a fraction of that amount of money and use it to pay employers to make it easy for people to get the savers credit.
Yeah, I agree with Josh. And the first step, I think, is going to likely be thinking about the savers credit and how it can be expanded for retirement. And it is critical because middle and higher income people get a large benefit from the tax deduction that's in place today. But as we know, a lot of lower income people don't have net income tax liability, federal income tax liability. And so they don't get to take advantage of the savers credit, which is a credit that is primarily targeted at that population. But again, it's not refundable. And so we need to make sure that they have similar incentives to save and frankly, similar benefits to saving as the rest of the population does. So that's the first step. But then on emergency savings, Josh is right. We should look at ways that we can put in place relatively small financial incentives, whether it's on the employee side, whether it's on the employee side, and it can range from allowing employers to make matching contributions for emergency savings that could be tax preferred up to a certain relatively small amount. It could be paying them to set up these accounts, as Josh is saying. It could be matching employee contributions into these accounts or applying the savers credit to emergency savings as well. So there's a variety of different ways that we could put federal dollars in place. I think the first step is getting more of these accounts set up, automatic enrollment, clearing the barriers to that, because then we can see how effectively these accounts are working and the potential that they could have. And then we can analyze what these different steps are in terms of financial incentives to get more and more people using them and getting greater benefit out of it.
Mm-hmm. Mm-hmm. Melissa, any thoughts, or are you ready for me to go to my final lightning round question?
I think Shai and Josh have done a great job.
Okay. Okay, so my last question, and then I'll close this out. Just quickly, what is the one thing that you'd like to see happen next, or the thing that you're really most sort of waiting or watching for when it comes to creating the right policy environment for automatic workplace emergency savings? What is that thing that you're sort of most focused on? And I'll take anyone who wants to go first.
I mean, I will say, and Shai sort of alluded to this, I think that I am like really excited. I'm like, not that we're competing with the Langfords and Bennetts, but I am excited, and I think that we'll see an uptick in different members who may have not weighed in before, see this like this late summer, early fall to be an opportunity here to do something on these issues. I think that it's definitely, I think the ERISA 2 or Secure 2, whatever, whatever side you're calling it, is a really exciting opportunity, especially for bipartisanship at a time when it seems like all we're doing is reconciliation. I think that this is a space where there is actually a lot of, potential for bipartisan agreement and many different ways to approach it. So I even though it'll maybe feel a little crowded, I am really excited to see what other options put out and what the conversation might be ahead of those talks.
Awesome, thanks, Melissa. Josh or Shai? Who wants to go next? Okay, fine, Shai,
Sure.
and then Josh.
Sure, I'll piggyback on Melissa, which I think is exactly right. And particularly with the bill that her boss is leading, we're working with them to make sure that we give maximum opportunity for employers and record keepers to innovate in a variety of ways. What we didn't really touch on here is that there are some employers that are looking to do, some plan sponsors of retirement accounts that are looking to attach this to the retirement account and have it be sort of a sidecar. Although very good public polling from AARP, which is another group that has been in this area, which is fantastic, has showed us that we should not be calling it sidecar, so we'll call it anything else, but something that is attached to the 401k account. And then there are a bunch of other innovators in this space that are looking at standalone emergency savings accounts. And I think this is especially important because, as we know, a lot of the population that this might be most helpful for don't actually have access to a 401k or a standard workplace savings account. So making sure that the legislation that's moving forward to enable automatic enrollment is covering both of those areas, folks who want to do it within a retirement account and folks who want to do it separately, and setting just general rules of the road, best practices, and then letting the innovators move forward. That, I think, is an exciting opportunity, and hoping that, as Melissa was saying, that it can be incorporated into some type of legislation moving later this year.
Great. Josh, final word.
I think Shai said it exactly right, which is there should be experimentation. There should be freedom and economic incentives for employers to help their employees save for emergencies, and for people to save for emergencies. This is a combination of rethinking regulation and, let's be honest, some money to get employers and employees to do stuff that they might not otherwise get around to doing.
Mm-hmm. Mm-hmm. There's a lot to chew on. I'll just flag that. I'm watching people in the chat ask if we can print all of this all the commentary, and I'll let my friends who are better with Zoom here at FSB figure that out. But I just want to step back and thank all three of you, Josh and Shai and Melissa, for joining, and also thank your organizations for the work that you're doing on this issue. And there's a broader circle, and I know throughout the day we've been thanking a variety of others, real leaders and thinkers in this space. And it's really such a privilege to get to work alongside of such great folks sort of in service of helping everybody in America get access to sufficient emergency savings, right? It's so critical. So Josh, Shai, Melissa, thanks again for joining. And I'll invite you to go ahead and I can release you into the wild. Turn off your cameras. Thanks to everybody. And Saurabh, our MC, please do come back and join us and help close us out here.
Yes, and I will be joining on video. There we go. Well, thank you so much, Karen, Melissa, Josh, and Shai. And thanks to all of our speakers today for joining and sharing such important insights. Also, many thanks to Save Your Life and their members, Sierra, Shakira, and Kimberly, for adding much needed context to these conversations. These were really powerful discussions, and that last panel, I think, highlighted the importance of automaticity. That also illuminated that we need to be thinking about comprehensive approaches with room for many solution options with adequate incentives. One-size-fits-all solutions aren't really feasible to achieve the scale and impact we're talking about here. For me, it's clear that liquid savings are absolutely critical to household financial security. It's also clear that people want to save, and there are ways that we can and should support this. We must continue to build systems that enable households to accumulate and replenish their savings. And I'll echo many of our panelists and participants today. we must also fundamentally meet the need for more cash coming in for households. Now is the time to act and address this with urgency. With that, I'd like to thank all of our attendees. I hope you gained something from tuning in. I hope you pass along what you've learned with your colleagues and networks, and I hope you see the opportunity to take action. As we close, I'll remind you that we will be publishing a recording of the event. And in the meantime, please stay in touch by signing up for our newsletter with the link here, and follow Aspen FSP on Twitter at Aspen FSP. So with that, thank you so much for joining us. I wish you all the best today. Take care.